Hello students and welcome to the lecture. So students, as you know that we have started our discussion over the Reserve Bank of India banking and currency system in the previous lecture, right? Basically we had discussed that the banking and the currency. These both are generally regulated by the Reserve Bank of India because Reserve Bank of India is an apex banking institution in the country. So that's why it's having the regulating rights to regulate the banking sector of the country. And because it is the formulating authority of monetary policy, that's why it's also having the access to control the currency system of the country. Okay. In the part one, we had discussed about like how did the Reserve Bank of India formed. Okay. Like we had discussed, they were the presidency's banks, which the Britishers merged in the Imperial Bank of India in 1921. Then they wanted it to be the Central Bank of India. But the Hilton Young Commission opposed this and recommended a new separate banking institution that was the Reserve Bank of India. That was established as a private stakeholder. Why? Because the ultimate aim of Britishers behind establishing the Reserve Bank of India was to separate the credit and currency system from the government. Got it? But when we got independence, we wanted the bank to got merged with in the coordination of the government policies. That's why we nationalized the Reserve Bank of India in 1949. Okay. And thereafter, we have seen the functions of the Reserve Bank of India, important timeline we had seen. We had seen the monetary policy of the Reserve Bank of India and other things. Now, in this lecture, we are going to talk about the main points that we couldn't discuss in the previous one because of the some conditions. Now, in this lecture, we are going to talk about the important points that are related to the monetary policy making. How does it make? Whatsoever are the instruments of the monetary policy? Whatsoever are the types of money? Then the MPC stands out for the Monetary Policy Committee. Composition of MPC and the summary of all of these. Okay, that is what we are going to see. I hope you have revised the previous lecture in the well enough manner before you have come for this lecture. As many times I have told you that is for your own benefit. If you are doing this on the regular basis, the thing will be in your favor. If you are not doing this on the regular basis, the thing might be against you. Okay. As usual, before starting the main lecture, we have a small disclaimer presented over here that we require to discuss before we proceed further. Right? So a disclaimer is like that. The images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. Now, let's begin with the topic. So the important points related to the monetary policy making. Like we know, the Reserve Bank of India controls the currency system through the monetary policy. Like how much the money flow should be in the economy, what should be our inflation target, and how we will achieve this. Entire things are planned by the one single organization that is known as the Reserve Bank of India. Right? So that is why the monetary policy is an important. Because we know there are the two types of policies basically works in the economy, the fiscal and the monetary. The fiscal policy is formulated by the Ministry of Finance under the Government of India, and it's primarily deal with the government spending and the revenue part. Got it? Monetary policy that deals with the money circulation is made by the Reserve Bank of India, and they both are closely aligned with each other. Because when the government spends in the economy, ultimately they are going to infuse the money supply. Okay, and when the government earns from the economy, ultimately they are decreasing the flow of the money in the economy. That's why the Reserve Bank of India, because it is in charge of formulating the monetary policy, has to be in coordination with the government so that our targets, our aim, our objectives, these could be achieved within a formal manner. Okay. So here you can say under the amended RBI Act, the monetary policy making is as under. Now here you can say amended RBI Act. What does it mean actually? Remember, when the Reserve Bank of India got established, it established as the private stakeholders body, right? So that's why when Indian government take over this, so Indian government passed the RBI Transfer of Public Ownership Act 1949 to nationalize it. So that was actually an amendment act, which means government used the previous RBI Act with just little bit modifications. Okay. So here you can see the Monetary Policy Committee MPC is required to meet at least 4 times in a year. Why? If we talk about the financial year that starts from 1st April to 31st March, that year actually having the 4 quarters, right? These 4 quarters are repeating in every 3 months. In every quarter, our inflation targets, our economic targets different. Okay. Based on the previous achievements and failures that we had suffered. So that's why at least 4 times or 4 quarters they required to be met. The quorum for the meeting of the MPC is 4 members, which means at least 4 members of the entire committee must be there to start the meeting. If the quorum is absent, the meeting will be cancelled. Each member of the MPC has 1 vote. And in the event of equality of the votes, the governor has a second or casting vote. Like you can say, suppose if there are the 10 members in the MPC, alright, everyone having the 1 vote. So 2 decisions have been taken, decision A and decision B. In favor of decision A, 5 votes have been polled. In favor of decision B, 5 votes have been polled. Now you can say 5-5, equality is there. The governor of the Reserve Bank of India, who is also the chief executive officer of the bank, he is actually the ex officio of the committee, which means he does not have any kind of voting rights. But when there is a equality of votes, okay, then he could use his casting vote or second vote to decide whether they want to go. Like if there are 10 members and 1 governor, total 11 members, the governor does not have any voting right. So we will not count his right in the starting. 5 in the favor of A, 5 in the favor of B. So now governor has to decide whether he want to support plan A or plan B. If he will support plan B, then it means plan B will have 6 votes and plan A will have 5 votes. So plan B will be implemented. Similarly, if we select plan A, so plan A would have 6 votes and plan B would have 5 votes. So plan A will be implemented. So that's how the casting voting nature of governor works. Now let's have a talk of the instruments of monetary policy. Now, in order to controlling the currency system through the monetary policy, first we have to control the banks. Why? Because banks are the main infusion of the currency in the economy. How? Like if you having the savings, which means you are having the currency. If you submit it in the bank, so you have infused the money to the bank. And if the bank lended out to the someone as a loan, then the bank has fused that money in the economy. So that's why banking are the, you can say banks are the main organization or main source through which the money controls in the economy. All right. So there are several direct and indirect instruments that could be used for implementing the monetary policy. First, you can say is the repo rate. It is the fixed interest rate at which the reserve banks provide overnight liquidity to banks against the collateral of government and other approved securities under the liquidity adjustment facility. Like you can say, suppose if the bank is running out the liquidity or running out the cash, okay, and the bank required the cash immediately in order to provide the loan or in order to return the deposit of the money that has been deposited with the bank from someone, then the bank could ask the overnight liquidity from the Reserve Bank of India. And the bank has to give some collateral of government securities and other approved securities holding by the bank. Okay. And this is an overnight liquidity. It means the bank will get it immediately, but at a fixed interest rate. The bank is required to pay the interest rate to the Reserve Bank of India. That is not free of cost. Got it? Then, what is the reverse repo rate? Okay. There is a one thing that I missed. Whenever the inflation is high in the economy, what does it mean? It means that the currency flow is higher in the economy. When the people will have money, automatically they will spend. Okay. And when they having the capacity of spending the money in the economy. So remember, there are only two things that controls the entire things: demand and supply. Okay. When the people will have money, they will automatically start demanding. And to meet up their demand, the supply will not be that easy. All right. So whenever the demand will be higher and the supply will be lower, always the condition will be an inflation, which means the prices will be higher. Whenever the supply is higher and the demand is lower, the prices will be lower. Okay. So when the inflation is high, it means the people already having a money with them. Then the Reserve Bank of India will increase the repo rate so that the bank will avoid granting a loan. Okay. So the automatic flow of money into the economy will be controlled. All right. That is why the repo rate introduced. Second is the reverse repo rate. This is the fixed interest rate at which the Reserve Bank absorbs the liquidity on an overnight basis from banks against the collateral of eligible government securities under the LAF. Now, this is a reversible condition. Why and how? Like the repo rate is a condition when the bank is going to the Reserve Bank and asking for the overnight liquidity, right? In this reverse repo rate, basically the Reserve Bank of India going to the bank and asking for the overnight basis liquidity. It means that now the Reserve Bank of India taking the loan from the banks. And why the Reserve Bank of India does this? Because to absorb the liquidity. Okay. Like every bank knows, the Reserve Bank of India is the safest option to granting a loan because the bank could not default. Right? So suppose now the inflation is higher. And if the banks will provide loan to the normal people, to the general people, automatically the people will take this money to the market. Okay. And the inflation will be higher and higher. Right? So that's why the Reserve Bank of India reaches the banks and takes the loan. When the Reserve Bank of India takes the loan, so ultimately the deposits of the bank will be lower, right? So this is generally higher whenever the inflation is high. Why? So that the banks find it attractive to grant a loan to the Reserve Bank of India on high fixed interest rate, all right? And whenever there is a low inflation or the condition of deflation in the country, then automatically this repo rate will be low, reverse repo rate, sorry. Which means now the bank will not find it attractive to grant the loan to the Reserve Bank. And so they will grant it to the normal people. So the normal people will have the money, go to the market and spend it. All right. So now you can say, here we have talked about LAF. Previously, we have talked about the LAF. So what does this LAF actually means? So LAF stands out for Liquidity Adjustment Facility. What does it mean? Liquidity Adjustment Facility. Okay. So it is RBI's Liquidity Adjustment Facility, which helps bank to adjust their daily liquidity mismatches. Like you can say, if the bank requires 10 lakh deposit with it, for example, okay, to meet the demand deposits and other kind of liabilities the bank possesses. Okay. Now, the bank has granted rupees 8 lakhs to the people who were taking the loans. How much left with the bank? Only 2 lakhs. Those people who had deposited their 10 lakhs to the bank, out of those, some people come whose amount is 8 lakh rupees. Okay. Now bank only having 2 lakh. So how the bank will repay this amount to the depositor? So bank will reach the Reserve Bank of India, takes a loan of 8 lakh rupees and then will return the deposit to the people who had deposited the amount with the bank. Similarly, if bank only having 2 lakh rupees and the loan demanded for 8 lakh rupees, the bank will go to the Reserve Bank of India, take the loan, granted it to the people, and then return it to the Reserve Bank of India on some terms and conditions. So that's how the daily routine liquidity mismatches of the bank could be adjusted by the Reserve Banks of India's Liquidity Adjustment Facility, or in short known as the LAF. Okay. It is having the two components, repo, repurchase agreement, and reverse repo. Remember this. When banks need liquidity to meet its daily requirement, they borrow the RBI through the repo. Like we know, when they borrow the money from the RBI, they submitted some collateral government securities or approved securities to the Reserve Bank of India against the loan. When they return the loan, the Reserve Bank of India return their security. Okay. The rate at which borrow fund is called the repo rate, the fixed interest rate that we have seen. When the banks are having the flush with fund, then they generally park with RBI through the reverse repo mechanism, which means now they granted a loan to the Reserve Bank of India and take the security from the Reserve Bank of India. When they take their money from the Reserve Bank of India, they return the security to the Reserve Bank of India. Okay, so that's how the liquidity adjustment facility works. Got it? Now, the another instrument is the MSF, stands out for Marginal Standing Facility. It is a facility under which the SCB or Scheduled Commercial Banks. Now here we have talked about the Scheduled Commercial Bank in the previous lecture. Now we are talking about, even in some previous lectures, we have talked about this. So what are the Scheduled Commercial Banks actually? So those banks which are registered under the RBI Act 1934's second schedule, these are termed as the Scheduled Commercial Bank. Got it? So these banks could borrow the additional amount of overnight money from the Reserve Bank by dipping into their statutory liquidity ratio portfolio up to a limit at the panel rate of interest. Which means, suppose through LAF they had borrowed some money, but due to some conditions the bank finding it not suitable to continue with that amount, so they requires the additional amount on the overnight basis. So they could borrow more amount from the Reserve Bank of India under the marginal standing facility. Like we could say this is an additional amount given on the overnight basis. This provides a safety valve against the unanticipated liquidity shocks to the banking system. Unanticipated means it is unexpected. The bank did not expect this shock from the banking system. So that's why we could say they require the immediate money. All right. The corridor, the MSF rate and the reverse repo rate determine the corridor for the daily movement in the weighted average called money rate. Okay. Now, the bank rate, what is it? So the bank rate, it is the rate at which the Reserve Bank of India is ready to buy or discount bills of exchange or other commercial papers for long term. Bank rate is published under the Section 49 of the Reserve Bank of India Act 1984. Okay. Like you can say, suppose the LAF, the repo rate, the MSF, these are for the short term, overnight basis. The bank immediately requires a fund. They take the fund from the Reserve Bank of India, they return it. Okay. Bank rate is actually come in the long term scenario. How? Like you can say, basically the bank requires the money for the long duration. Okay. So because RBI is the banker to the bank, so the bank will receive the option to reach the Reserve Bank of India. And when they will reach the Reserve Bank of India, the Reserve Bank of India will grant it a loan to them, but at the bank rate. The bank rate is actually the interest rate chargeable on the loans and all that has been granted from the Reserve Bank of India to the banks for long-term purposes. And it is mentioned under the Section 49 of the Reserve Bank of India Act 1934. This rate has been aligned to the MSF rate or marginal standing facility rate. Therefore, changes automatically, and when the MSF rate changes alongside policy repo rate changes. Okay. Thereafter, the cash reserve ratio, CRR. Okay, there is a one thing condition. When the inflation is higher, the bank rate will be higher. When the inflation will low, the bank rate will automatically low. Now the CRR, the cash reserve ratio. It is actually the average daily balance that a bank is required to maintain with the Reserve Bank as share of such percent of its NDTL, net demand and time liabilities, that the Reserve Bank of India may notify from time to time in the Gazette of India. Now, what is this cash reserve ratio? In order to understand this, first we have to understand a scenario. Like suppose if the bank having the 100 crores fund, okay, the bank could not lend out the entire fund to the people who were seeking the loans. Like so many times I had told you, no one is more greedy than the bank, right? I had told you this thing. Why? Because the bank tries to give more and more loans and try to generate more and more revenue for themselves. Okay? But the person who had deposited the money with the bank, the person would become a victim of some crash if the bank fails to get back his money which it had granted as a loan. Right? So that's why, as per the instruction of Reserve Bank of India, some percentage from their fund, the banks are required to keep with the Reserve Bank of India as the cash reserve ratio. So that whenever the bank requires an urgent condition under the net demand and time liabilities, the bank could utilize that from the Reserve Bank of India. Okay. Generally, it is 4% of their NDTL. Okay, but that could be changed time to time as per the monetary policy targets. Got it? Like you can say, suppose if 100 crores is the total amount the bank holding. So the CRR will be like 4 crores, for example, only. The 4 crores amount the bank is to be parked with the Reserve Bank of India. Okay. So whenever the inflation is higher, automatically the RBI raises the cash reserve ratio. So the more and more money from the bank could be reserved with the bank, Reserve Bank of India. So when the banks will have low funds, they will not grant loans that easily. Okay. When the people will not have the money supply, they will not expand it and automatically the circulation will be controlled and the inflation will be low. If the inflation is low and the deflation conditions are there, automatically the Reserve Bank of India will lower the cash reserve ratio. So the bank would have more funds to grant as a loan. When the people will have money in their hands, they will go to the market, spend it, and automatically the money circulation will be high. Okay, so that's how the cash reserve ratio works. Then when we move forward, we got the statutory liquidity ratio, or in short known as the SLR. The SLR is also the same like the cash reserve ratio, but with some minor differences. The share of NDTL that a bank is required to maintain in safe and liquid assets such as unencumbered government securities, cash, and gold. Changes in SLR often influence the ability of resources in the banking system for lending to the private sector. Like after deducting the cash reserve ratio, whatever the amount the bank will left, okay, from that amount, certain percentage the bank has to keep it as a SLR. Okay, statutory liquidity ratio. Got it? And this SLR will be the safe and liquid asset option with the banks. Like the bank not required to keep it with the Reserve Bank of India. The banks are allowed to keep it with themselves. And even the bank could purchase some unencumbered government securities, cash and gold. Okay, with them. So that is also to control the fund of the bank. So whenever the inflation is there, automatically the SLR will be higher. Whenever the deflation will be there, automatically the SLR will be low. Then the open money market operations, OMO. This include both outright purchase, the sale of government securities for injection and absorption of durable liquidity respectively. Like open market operations are done by the Reserve Bank of India in order to control the money supply in the economy. How? For example, if the money supply is already higher in the economy, then the Reserve Bank of India will sell out the government securities in the market. So when the people will purchase the security, they will give the money to the Reserve Bank of India. The security will be holding by them. Automatically, the money will be absorbed from the economy. Okay. Similarly, when the deflation is there, the Reserve Bank of India will repurchase the securities. So the bank will get the security and will give the money to the people. When the money is with people. The people will spend out the money in the economy and automatically the circulation will be high. So that's how the sale and purchase mechanism under the open market operation works. Then the market stabilization schemes, MSSS. The instrument for monetary management got introduced in the year of 2000. This is a surplus liquidity of a more enduring nature arising from large capital inflows absorbed through the sale of short-dated government securities and treasury bills. The cash to mobilize is held in the separate government account with the Reserve Bank of India. Okay. Now, types of money. But the first question that we have to deal with is what is money actually? What do we mean by the money? So money is basically a medium of exchange which a person uses to satisfy his wants, like to purchase the things and sell the things. Ideally, the money has three critical characteristics, which are: first, it acts as a medium of exchange. Like you can exchange the money for something. If you are going to the market, you selected some phone to be purchased, you will give the money to the shopkeeper, okay, and the shopkeeper will give you the phone. So you have exchanged it for the phone. Second, it is an economic good because it is working for the economy. Third, it is the means of economics calculation. Like the value you could be calculated. Like if you're seeing some land, you want it to calculate its economic calculation. So you will say that this is worth 10 lakhs, 20 lakhs, 25 lakhs, 1 crore, 2 crore. What are these? These are the money. Okay. So types of money. First is the standard money. It is that form of money in terms of which all other forms of money in the country are measured. It is unlimited legal tender and subject to free coinage. Therefore, anybody could bring his metal and got coins made of it. In this time, its real and interesting value is equal to its face value, either made of gold or silver or sometimes gold. Okay. Token money. It is that money which is made up of cheaper matter. It is having some limited legal tender, not subject to free coinage, and its face value is greater than its interesting and metallic value because it is made up of the cheaper matter. Now, what is the commodity money? It is actually the simplest kind of money which was used in the barter system where the valuable resources fulfill the functions of. Like you can say, you could exchange the goods for the goods. The value of this kind of money comes from the value of resources used for this purpose. What is the fiat money? Fiat currency is the kind of money which do not have any interesting value and it can't convert into a valuable resource. The value of this money determined by government order makes it a legal instrument for all transaction purposes. Like now we have the paper money, the paper notes we have, even we have the coins. Now, a brief on the money supply. The total stock of money which is circulating in the economy is called the money supply. Involves the currency, printed notes, money in the deposit accounts, in the banks, and in the form of other liquid assets. Okay. RBI has referred 4 measures of money supply which are M1, M2, M3, and M4. These measures indicate the monetary liability of the money creating sectors like the Reserve Bank of India, commercial and cooperative bank, and the money using sectors within the country referred to as the public. Now, measures. First, M1, narrow money. Currency with the public plus demand deposit with the banking system plus other deposit with the RBI. These are covered under the M1 or narrow. M2, M1 plus post office saving deposits. M3, broad money. M1 plus type deposit with the banking system. M4, M3 plus total post office deposits. Okay, these are this. Now the currency with the people or the public. Currency with the public is arrived at after deducting cash with the banks from total currency in circulation. Currency in circulation comprises the note, rupee, and small coins. Demand deposit with banks represents the demand deposit with all the commercial and cooperative banks, including the cooperative societies. Other deposit with the Reserve Bank. Other deposit with the Reserve Bank of India for the purpose of monetary compliance includes a deposit from foreign central banks, multilateral institution, financial institution, balances in depositors, education and awareness fund, and sundry deposits net of IMF account. It stands out for Internationally Monetary Fund. Post Office Saving Bank Deposit, total accruals under the Post Office Saving Deposit. Time deposit with the banks represents the time deposit with all commercial and cooperative banks. Okay. Now, what is the reserve money? M0. Reserve money, also called the base money or high powered money, is the highly liquidity component of money stock in the economy, plays a crucial role in the determination of other monetary aggregates, represents the total monetary liabilities of the Reserve Bank of India. Monetary policy actions and market operations of the RBI cause changes in the size of its balance sheet could result in the changes in reserve. Now, the Monetary Policy Committee. Already we have discussed something on this. The Reserve Bank of India Act 1994 has been amended by the Finance Act 2016 to provide for a statutory and institutionalized framework for the MPC or Monetary Policy Committee for maintaining the price stability while keeping in mind the objective of growth. Committee was created in 2016 to bring the transparency and accountability in fixing India's monetary policy. The Monetary Policy Committee would be entrusted with the task of fixing the benchmark policy rate or repo rate required to contain the inflation within the specified target level. Committee-based approach for determining the monetary policy will add lot of value and transparency to the monetary policy decision. Meetings of the Monetary Policy Committee shall be held at least 4 times a year, and it shall publish a decision after each such meeting. As per the provisions of the Reserve Bank of India Act, out of the 6 members of Monetary Policy Committee, 3 members will be from the bank itself, and the other 3 members of the committee will be appointed by the central government to put forward the central government viewpoints in the policy making. The Monetary Policy Committee of India is the committee of Reserve Bank of India that is responsible for fixing the benchmark interest rate in India, and it is held the 4 times. The Governor of Reserve Bank of India is actually the chairperson of ex officio of the committee. Decision taken by the majority by voting rights, and in case of tie, basically the governor having the casting vote to break this tie. The current mandate of the committee is to maintain the 4% annual inflation with an upper tolerance of 6% and lower tolerance of 2%. Now the composition of the monetary policy. So this is the composition, like Governor of the Reserve Bank of India, Deputy Governor of the Bank, 1 officer of RBI, and professor and all. Okay. Remember, this could be changed time to time, so you have to recheck it by yourself. The composition of the committee. So here we have finished the topic. Now it's part of a summary. So we have seen the monetary policy and money supply, like the monetary policy framework, monetary policy committee and all. Then instruments of monetary policy we have seen, like repo rate, reverse repo rate, liquidity discount facility, margin standing facility, bank rate, statutory liquidity rate, open market operation, market stabilization schemes. Types of money we have seen: standard money, token money, commodity money, fiat money. Money supply we have seen, measures of money we have seen, like M1, M2, M3, M4. Reverse money we have seen, RBI Act amendments 2016 we have seen, and then the currency issue we have seen, notes we have seen, and with this we have finished this topic. So it is requested to all of you, kindly revise the facts and figures that all we have discussed in this lecture in the well enough manner before you go for the another lecture. With this note, let's end this lecture and thank you.